Welcome to the Daily Update. This is Being Prepared Monday, September 12th, where we'll look at the action in the market today and then see how things look for Tuesday, September 13th. And I must admit, I didn't really plan on doing a full-length video today. Everything that's going to be happening this week, we have CPI being released on Tuesday, PPI on Wednesday, retail sales on Thursday, consumer sentiment on Friday. We've had a nice run up last week. We were looking a lot more positive, possibly even a little bit short-term overbought. So I really expected Monday to be kind of a snoozer. I didn't really know we would have the up day that we had. It's helped our charts quite a bit. It's pushed us just a tiny bit more into a short-term overbought condition. And then in the wake of that, we will be getting the CPI report, which is probably the most anticipated report right now. And the market could go either way. It depends on how things are going to be interpreted with that. So to see positioning and buying the day ahead of that report, on one hand, you can say, okay, well, maybe things are going to go up from here and the CPI is going to push us harder to the upside. Or you could say, man, people don't really know what's going on here. They're getting fooled. They're getting suckered into the market. They're going to be buying right before we get set to have a downward move. We're kind of at that point right now because every day anything can happen. We look at the charts because it gives us the probability of what is most likely to happen, realizing that anything can happen and then we have to adjust and adapt to that. So let's go back and talk about what happened. Right at the open, we had a gap higher, and a lot of this came on the heels of Europe. They were pretty strong overnight with their markets, the DAX, the UK, pretty much across the board. Europe had a good session, and that helped give some support to the S&P futures. We ended up gapping above R1 at 40.88, and then pretty quickly we went all the way up to R2 at 41.10. We stalled out there, but we were able to hang on to those gains as the day went on. We retraced back down to R1, but then we bounced back up to R2 again, and then we remained near the highs for the rest of the day. We closed near the high, and we ended up being up 1.06%. So a pretty solid day. However, we're still just a tiny bit below average, the way that I measure it. I put a 50-period moving average on the volume, and if we're below that, we're below average. If we're above that, we're above average. You can do a 20-day, 152.5-day, whatever you want to do. I just measure it using a 50-period moving average. Other places might use a 90 to get a more broad reading. As far as what we're looking at now, the technicals are still showing a lot of improvement. Short term, we pretty much turned over positive. There's still some holdout areas, and there's also a couple of areas, as I mentioned, that might be even a little extended to the upside. Doesn't mean they have to stop here. We could still go higher than that, but they're looking a little overextended, and I'll show those charts to you. Of course, right here, right now, the big focus is tomorrow with the CPI coming out. That is what everybody's been waiting for. We set up for that last week, and then they're going to be anticipating, what does it say? What does it mean? And then how's the market going to react to that? That's really the biggie right now. Of course, we have all the geopolitical concerns, earnings that might be released, the recession going back and forth. That kind of feeds into the inflation interest rate scenario, and then any Fed speak that may come out. So let's make some comments. The buying momentum, it still continues, and I have to clear my throat. Sorry about that. Ahead of major inflation data that's coming out this week, and I already mentioned all of those. We have some big reports, with the CPI probably being the biggest. The US dollar weakness that we've been seeing, the dollar's been pulling back. That's been giving some support to stocks. And if we want to see stocks still continue to the upside, we'll probably have to see more weakness in the dollar. Since you have Europe starting to raise their rates and doing it more aggressively, that's giving some support to the euro. When the euro goes up, the dollar goes down. Then the technicals that we're looking at continue to improve with some short-term overbought indications. The sector rotation and our positive setups and our scenarios, they're showing some improvement. and the 10 to the 5, the 10 to the 2, this is what I say every day. It seems like those yield curves remain inverted. Some of our inverse correlations are shifting as we're seeing this bounce up and this momentum to the upside. Sentiment is still neutral. With the update, we kicked back more into the neutral area. We didn't have any economic reports that came out in Monday's session, and that's another reason why I thought maybe it'll be a little bit slow. Well, sometimes you anticipate what will happen and you end up having to adjust that. Our trend, it's turning positive. We have the green line crossing above the red line, but it's still weakening because those lines aren't very far apart. The red and the green are not far apart. We're just barely above 20 now. However, our bias is positive with the update, and we've had now 4 up days, so our momentum is positive. Let's go back. Here's sentiment right at 48. At least that's the general broad reading. Now, we had some extreme pessimistic readings with the American Association of Individual Investors. There was the investor sentiment that comes out that was kind of flagging that we're showing some extreme pessimism. But with this index that we use, we really have been about in the middle. And then here is the latest reading for the RIDEX bear bull ratio. This is as of Friday because we get some lagging data updates here. We're still pretty much in the middle here. We spiked up a little bit. People are getting a little bit nervous about this, which could help the markets. If everybody is starting to position themselves for things to go down, the market often has a tendency to do the opposite of that. Doesn't mean they're always wrong, but they're wrong most of the time. And here's some Isabel net charts just showing if you take all the different areas that folks invest in with these stocks, bonds, government bonds, and money markets still continue to be heavily favored right now as people are confused and they don't really know what to do. So sometimes cash is king. And if you're only a long investor, so you only hope to buy low and sell high, you may be in cash right now, just kind of waiting to deploy that. And so you're not really sure what to do. When in doubt, go to cash. That's what a lot of people end up doing. We're seeing outflows. And again, these charts are a little bit outdated here in the equities, but now we're starting to see some more inflows. That hasn't shown up on this chart yet, but when things go up, people have a tendency to put more money to work. But as of the time this chart was produced, it showed that we're seeing a lot of outflows, but that was more when we were headed down. Here's some kind of technical analysis look. You might want to pause this and look at it. I hope I've been addressing most of the issues that are in this chart. Here we have this one downtrend where we came right up to the 50-day moving average. That was rejected and we came down. We set a bottom and then we've been coming back up. Here just lists some of the different resistance levels. And some of these I've been pointing out in the videos that I do just to give you an idea, okay? And even this chart is now out of date because we actually went up closer to this next resistance level currently. And I'll show you that with the charts that I have. The buybacks. This is when a company says, we're going to go out and buy some of our own stock back. And that's typically seen as positive because that takes some of the shares off of the market, making them more precious. And then if a company says, we're willing to put our money out there to buy our own stock, that's also seen as positive. Well, so far for 2022, this is where we're at, where I'm circling with the cursor. We've had better years, but we've also had worse years. And this dotted line here is 2016. So it just shows that companies have been doing a lot of buybacks. And if things turn back more positive, we may see more of that going forward from here. Here's the euro to the dollar. And of course, I don't know why Goldman Sachs seems to just hate the dollar. They're just totally convinced that the euro is going to go up. And we've seen a few of these charts and they've been wrong. They've suggested that the dollar has topped out. It's going to start going down. The euro is going to go back up. Well, right now, we just dropped a bit under parity with the euro, meaning that the dollar had greater value than the euro. The exchange rate was quite favorable, but they expect the euro to continue to advance and actually become over par with the US dollar. Then the debt that companies have right now, it's actually quite low, and that could be seen as positive. Well, if you look at all of the stimulus, all of the packages, all of the lockdown things that happened, a lot of companies took that to clean up their balance sheets and to get rid of a lot of debt and to take advantage of some of the things that the government was making available to them. So it's just showing on a historical basis that US corporate debt is relatively low. Here's another sentiment gauge kind of leaning over, but again, this is a few days old now, where we're tipping a bit over to the fear side. With the couple of updates that may be added to this calculation, we might be right in about the middle, as we are with our other fear and greed index. GDP now continues to be updated. This, according to the Atlanta Fed, suggests that they're looking at a positive GDP for the third quarter, which means that we would not be in a recession, at least according to that definition. One chart that I show quite often are the initial jobless claims. Well, this is the continuing jobless claims. We get this every week, and the headline number is usually how many people filed for the first time. And I show charts of that when they are available. Well, this chart shows how many people are continuing beyond the first week, and it's starting to come up a little bit, but still, when you compare it to other years, it's quite low and still suggests that the employment situation is really quite strong. Looking at our sectors, we had growth up 1.25%, where value was up 0.87% for the growth versus value comparison. Mid caps, this is where we saw a lot of the strength last week. Well, we saw value outperform growth in Monday's session. And with small caps, which are still lagging, in fact, they're in last place now as far as our technical analysis score, value's been going up and growth was up, but not as much as value. For our sector rotation, we want to see growth consistently outperforming value. And we're seeing that with the large caps, but not with the mid and small caps, at least on a short-term basis. The VIX actually spiked up a little bit. Do you think some folks are hedging ahead of Tuesday's report that's coming out? We spiked or turned up slightly. We're just about at the underside of this moving average on a closing basis, and the bar chart came up slightly as well, because you got a lot of folks that they're not sure what's going to happen, and so they figured, well, we better, if we're long, we better buy some puts, and that has a tendency to make the VIX go up, where we're still seeing the VIX of the VIX still relatively low, and it actually declined. The Ulster index was pretty much flat from on Monday, looking back to Friday's session, and we're down 14.70% from the all-time high. And we're seeing a little bit of a spike up with the equity put call ratio. Again, this could be folks hedging ahead of some big economic data that's coming out, just to be safe. They're willing to give up some of their return to protect their investment. But we're still seeing a decline with the 5-period moving average of the equity put call ratio. Here are the pivot points for Tuesday's session, which again, you may want to pause and use those. Just amazes me how accurate these are day after day after day. Here's the daily chart where we were able to break above the pivot point, and that's quite positive. So we're above this longer term resistance. Now, if something starts to happen and we end up going lower, will this end up acting as support? Because we've broken through it now. So that could be positive. We do have some overhead resistance coming up. And in this choppy environment, we're going to see a lot of that because we've been in these areas before. These price levels are not strange to the market. So once we start to come back up to those areas, it would not be surprising that other areas would act as either resistance if we're going up or support if we're going down. And then at the bottom, you can see volume was just a teeny tiny bit below average. Here are the monthly pivot levels with the updated chart. And here's one of the fib levels, and this is really short term. This just goes back to the high that we set in August down to what possibly could be the low, at least for right now. And we've retraced a nice chunk of that. We've actually got back up above, just slightly above the 50% retracement from that decline. Here's a little different look going from the high set in April, actually it was in March, to the low set in June, where we had recouped 50% of that loss, came back down, and we're starting to come back up to this 50% level as well, but we're slightly below it. All right, and okay, how come the slide didn't change? Then here's a longer term look. This goes to the all-time high set in January to the low set in June. And we're coming back above the 38.2% retracement on this chart. So we're breaking through some resistance to the upside, and that can be seen as positive. Here's a longer term chart going to the low that was set in 2021 to the all-time high. We still have some overhead resistance. So we're starting to break through short and even a bit of intermediate term resistance. It's the longer term resistance, if we keep going up, that we'll have to focus on now. And here's just another look where we're above this 50% retracement and these overlapping fib levels. Well, we still have some overhead resistance above where we're at currently. And if the market keeps going up, we will have to deal with those levels. As far as the sectors, energy did the best in Monday's session, followed by tech, with staples doing the worst, even though all 11 sectors were up on the day. Here are the scooter technical scores, with energy and utilities being in the 90s, the upper 90s, and discretionary. See how this has been just coming back, sneaking back. Now its chart is starting to look better, and it's getting a much higher score. It's above 90 now, where communication still is struggling at under 10. Here shows how the energy sector has been recouping a lot of what was given up earlier. Utilities still are hanging in there, and I have another chart that I kind of unveiled in the intermarket analysis video. I'm going to include that as part of the possible positive scenarios and just go through that each day and see, is that telling us anything? And then all of the other sectors that remain negative. Here is just an update of the percentages of what the indexes have done since the S&P hit its all-time high back in January. Here's another look at that with the S&P in the middle. That's this blue line here. And it shows just going back a month from, actually a year, from September of 02. No, not a year. It's going back to September 9th. Okay, I saw the 22 and that kind of threw me for a loop there. How discretionary has really been performing the best, followed by materials, financials. These are a lot of areas that really got hit hard earlier, and energy has been the one that's been underperforming. But this is a pretty short-term look at things. Technical alerts, they were all positive. We had the NASDAQ go above 12.2. Then I guess it went down to 12.1, then 12. Okay, these must be in reverse order here, because usually they start at the bottom and go up, and you would think the numbers would go in the other direction. As far as the S&P, we did get above 4,100. So just a few days ago, we were at 3,900. Now we're dealing with 4,100. And we have a number of MACD crossovers that are positive and bullish percent indexes that are crossing above 50. Canada is seeing a bit of a bounce as well. So pretty much everything was positive in Monday's session. The mid caps still continue to do the best. They were up, and they're getting up to the 79.1 range. If we can get this into the 80s, and then even better into the 90s, that's going to help this chart look a lot better. And then here is the change in these values over time. Now, the S&P has gone into second place, where it's up to 70 now, and also showing some improvement. Where the Dow, which had been hanging in there really well, it's falling off a bit at 62.6, where the Qs had been in last place. They jumped up and showed some improvement at 46.8. And now we have small caps, which have really been lagging, which could be a point of concern. If the market's really getting ready to jet higher, we want to see small caps doing better than they have been. So that's, again, just another warning sign. Intraday, here was the gap up. We gapped above R1, went all the way up to R2, went sideways, eventually fell down to R1, but then saw some more buying coming in. and then just trailed along R2 for pretty much the rest of the day and closed just slightly off of the high for the session. So the fact that we were positive and saw some selling, but then buying came back in, this is looking a lot more positive. Is it all going to change on Tuesday? Looking at our trend, we have the green line really starting to break away from the red line, but they're still fairly close together. So the ADX continues to drop. It's just barely above 20 right now, but it is below the moving average. The Arun not helping us now. It's not changing. You can see the oscillator's been flat for the last few days. We're seeing some improvement with the advanced decline line based on price. And we're seeing some pretty solid upward movement based on price, and even a lot of improvement based on volume. So that's looking better. The advanced decline ratio is turning back more positive. It's above 0 and advancing. New highs, new lows, starting to turn up a little bit with the 5-period simple moving average. We would really like to see this break out. That's been a point of concern as of late, where we've been bouncing back up, but we're not seeing a real breakout in new highs and new lows, probably because we've hit these areas in the not so distant past. So we need to really break out up here for the new highs to really start shooting up as well. The 10-period is still pretty much flat, measuring the new highs, new lows. Accumulation distribution is also showing improvement, and we're above the moving average. Short term, I just wanted to show you this. After Friday's session, we were just a teensy bit extreme. We wore off some of that, even though we had the up day. On Monday, rate of change starting to look a little bit extreme positive when we go back 5 periods. That's the only rate of change chart that's really giving us any concern right now. We were able to get back above the 20. We got above the 20s, the exponential moving average on Friday. Now we were able to get back above the simple moving average. So that is, again, showing that things are more positive. Here's our short-term rainbow, where we're coming back up into the rainbow as well. The more we can get up here and stay above these moving averages, the more likely they are to turn up. Here's our moving average tree, where we're starting to reclaim some moving averages, and we were able to get back here again above the 20-day simple moving average. We still have some other moving averages above where we're at, the 100 exponential, and then right now the biggie would be the 200-day simple. That's where we stalled out before. So if we keep going up, we'll really want to keep an eye on this. We'll probably watch this trend line coming down too, to see if that will tell us anything as well. Stoke Rsi looking a little bit extreme positive, where the Williams percent R still has a ways to go, so it's positive. The force index is still showing improvement. The Swindlin trading oscillator also positive based on price and volume. And the McClellan oscillator also positive. And our moving averages looking a little bit toppy with the 20 period, but advancing with the 50 and 200. So this is what I say by just a tiny bit short-term overbought. We're starting to get a little bit extreme. Doesn't mean we have to stop right here. We might, but it doesn't mean we have to based on this. We can still run this quite a bit higher if prices continue to go up. Stochastics looking positive with the short intermediate term and turning back up with the long term. We're starting to get or stay above the 50-period moving average, and that was a biggie. We reclaimed that one on Friday, and that was a pretty big deal. And now we're above the exponential moving average as well. And can we stay above that? 100. We're above the exponential moving average and the simple moving average right now. So this is looking better, and we were able to break above this pivot level as well. So you can see the improvements that we're seeing in our charts. Here's intermediate term. We're coming up out of the rainbow. And again, the longer that we can stay above this, the more these ribbons are likely to turn and look more positive. The Sean trend meter showed a little bit of an improvement, where the PMO still negative, but showing some improvement and could be getting ready to cross based on price and volume. PMOs that are rising, looking a little bit overextended, but this could still go higher. We're back to positive with the buy signals and turning up with those PMOs, the percent of PMOs that are above 0. Chaikin oscillator, positive. Chaikin money flow, positive. Volume dropped off a bit from Friday, so we're seeing that roll over and decline slightly. The vortex still negative with the red line on top, but it is really declining as the green line is advancing. The summation index based on price is turned up and volume has also turned up. Our oscillators, we have slope just starting to cross over positive, and then at the bottom we have the TSI crossing over. The other oscillators are looking better, but they have not crossed over positive yet. BPI is still above 50 and advancing. That's positive. Ease of movement also showing improvement on the 14-period basis. Ultimate oscillator also positive. Money flow index positive. Here's the 19-day exponential moving average of the advanced decline line based on price, showing a little bit of improvement, and based on volume, also some improvement, and not necessarily extreme with this measure. Here's the TTM squeeze. We're seeing these pale red lines continue to go up, and that is more positive. Balance of power has crossed below the dash line, so now the balance of power is in the positive camp now. And then here's the Cmb Composite Index, where we had the first signal generated when we crossed above this red moving average. That was confirmed on Friday, crossing above the green, and it continues to go higher. But see how we're coming up to a point where a lot of times this will top out. Looking at our charts, Heikin Ashi showing improvement and is looking positive now. The Kegi is black, so that's positive. Renko still has the open box that has turned positive. 3-line break continues to be positive. We added a new X on the point and figure chart. It took out that pole reversal signal. That's gone now. So we're seeing some improvement on the point and figure chart. Our elder impulse with the S&P continues to be positive, and we broke above this 65-period moving average, and the SPY is now also, okay, for some reason this chart didn't get updated. It would be up here, and it's showing some improvement. The SAR continues to have the dots underneath. And our go, no-go system, it's kind of hard to see this, but I look at it on a bigger scale here. Do you see these gold areas in here that it sometimes gives us? That's what's showing up right now in this area, which is more of a neutral reading. Long term, coming back up into the moving averages. But we're showing an improvement with the 50, 150, and 200-day moving average study. Special K still continues to decline. Takes a lot to turn that one. The diamonds broke above this moving average and is positive with the elder system. And here we're coming right up to the pivot. See how we broke a little bit above that, but then closed just below it. So that could be some more overhead resistance, but we are above the 50-period moving average. And the Qs also broke above this moving average as well and have turned positive. We're right at the pivot point now. Do you think the market's setting itself up to fall either way right here? Now, by fall, I mean by go. But it ended up stopping right on the pivot point. The Vixen ticked up just slightly on a closing basis, but really not much of a move with the daily bar. The NASDAQ also coming right up to the pivot point. Mid caps broke above the pivot point right now, and this is the index that's really been kind of leading the way higher currently. And the Wilshire also broke above the pivot point. So we're seeing some positive developments here on these other indexes. The dollar is still starting to show some weakness. It was down almost 0.2%, but it's still in an overall uptrend. But if we want to see a real big move in stocks, we're probably going to see some weakness in the dollar. And here's the relationship. As the S&P has been going up, the dollar has been coming down, and they have a pretty strong inverse relationship right now. Gold bounced up a little over 0.5% in Monday's session, but still in an overall downtrend. Silver, my goodness, was up 4.91%, but still in an overall downtrend. Oil was up to 87.78. And the correlation between the S&P 500 and oil is pretty much going back into neutral territory right now. Looking at bonds, not getting an awful lot of support. The total bond ETF was actually down based on price because interest rates are still continuing to go. But we saw the world bond index actually come up a little bit, but it's still fighting after dropping below the COVID low. The stock to bond correlation, although still strong, is starting to roll over a little bit. If this continues to fall, that means that stocks and bonds are more likely to go in opposite directions. Looking at the yield curves, as I say, it seems like every day, the 10 to the 5 remains inverted, as does the 10 to the 2. We continue to watch the 10 to the 3 month. And then the tech sector to the 10-year yield, that has gone back neutral. Yields, for the most part, in fact, for the whole part, advanced in Monday's session. So we're seeing interest rates going back up. As far as our scenarios, showing some improvement with those S&P 500 stocks above their 200-day moving average. We still went extreme down here, not extreme, but we had an extreme reading. We came up, came back down, and now we continue to show some improvement. Those S&P stocks above their 50-period moving average is also showing an improvement, as well as the mid caps, which is a stronger index right now. And the small caps, which are lagging, it still showed some improvement here. So we're seeing a slow reintroduction of our possible positive scenarios. Now, it could all change in Tuesday's session if the market doesn't like what comes out. Looking at the 10-day average of highs and lows, we're also showing some improvement. And this has gone a little slower because we're not really seeing a breakout in the new highs because we've been bouncing around these price levels before. So it's not generating a new 52-week high or low. So it's just kind of staying flat. We're still negative looking broadly across the market with the highs minus the lows, but it is showing some improvement. The equity put call ratio, longer term chart. After spiking up, we came down, almost created another spike, and have now been coming back down. The small cap index, although it was up 1.28% and was able to regain its 50-period moving average, it's still lagging behind the other indexes currently. And here's the ratio where it ticked up just slightly because it was a bit of an outperformer in Monday's session, but it has been really underperforming the S&P. It's not really helping this chart at all. We want to see this red chart start to go up and actually look like a bit of a breakout, which again could provide some support to the blue chart, which is the S&P 500. And looking at the S&P to the 10-year correlation, pretty much in neutral territory, but having a tendency to go more in the same direction right now. Looking at our sector rotation, seeing some improvement with the Qs. Discretionary has been kind of the hidden gem that's been showing a bit of a breakout, and the large cap growth versus large cap value still coming up to its moving average, showing some improvement there. Here is the large, mid, and small caps, and just showing how these areas are showing improvement. And then the S&P to the 2-year, they're starting to go in the same direction now. So we had the S&P up and the 2-year yield up. And that's kind of interesting right now, where we took out this earlier spike and now we're starting to create a new spike, which hopefully at some point in the future, that will be a legitimate spike. But as long as it keeps going up and up and up, that spike will just get higher and higher. Here's the new chart that I rolled out over the weekend. And the interesting thing about this, and I'm doing this the opposite way of what a lot of folks do. They usually take utilities to the S&P, and so that you have an inverted look. I did the S&P to utilities, which has a better tendency to line up with the tops and bottoms in the S&P 500. When you look at this, so like right at the beginning of the year where this spiked up and started to come down, that was the top in the S&P. Other times, like during other lows that we've had, when we hit a low and start to go back up, that is often marked a low in the S&P as well. So we want to keep an eye on this. And utilities have been doing well, but this has really been declining because the utilities are outperforming the S&P right now. So I would say this is a warning sign currently, where we're seeing prices really go up with the S&P, but this ratio is coming down, which means the S&P is underperforming, we want to see this turn and really go back up to give more support to the S&P going higher. And we're not seeing that right now. So that's a warning sign. The staples also were up 0.39%. And we're still looking viable here, where this last spike, this third spike over, we're still well below that and declining. So that's still positive from the staples. But we're a little bit concerned with the utilities doing so well. So you might want to keep an eye on those in Tuesday's session, the utilities sector. So what's our outlook? The technicals are improving and turning positive. We have the CPI and core CPI coming out, and that's why I have them highlighted. This is right now probably the most important economic report. We have the NFIB small business optimism. That's usually not a really big market mover in the Treasury budget. So the CPI is the big boy. And then all of the different things that are going on, Russia, Ukraine, they're still doing their lockdowns in many places in China. But in the US, inflation and interest rates and growth concerns are the really big focus. So our scenarios, we can go with the down scenario because of all these headwinds. And if the market comes out with this blowout number with inflation, it really could do some damage as far as price in Tuesday's session. If it's seen as market friendly, it could really help things go higher. So the market is fighting a lot of headwinds, but you might want to resist, at least right now, going with the down scenario because the technicals are improving and turning positive. The up scenario, yeah, things are really showing a lot of improvement in the short and intermediate term. Can this continue? What's the reaction going to be to the report on Tuesday? In our scenarios, they're looking better. And even though they're kind of on hold, they are showing some improvement. In the technicals, we're regaining some moving averages. We're breaking through some resistance. So those are all positive things. Can it continue in Tuesday's session? And then we're just barely above 20 with the ADX. The ADX is now positive. But if we kind of have a sideways day or the way this recalculates, this could easily drop below 20. Doesn't mean it's going to stay there, but it could drop that way. So our conclusion then is the S&P is turning more positive, but you kind of got to be aware right now, unless you're a little more aggressive with things. In the short term, positive, intermediate term, improving and turning positive, and long term, as long as we stay below that 200-day moving average, we are negative. So thank you. I hope you found this useful, and we'll just follow the action that happens on Tuesday and then see where things fall after that.